Okay, welcome back. We have the market which is selling off a little bit more, about 90 points. 24,200 is where we're at. Market breadth is still positive. 1,500 stocks are higher, and you got about 1,200 stocks which are down. And what is going up has got pretty much bulk of the volumes out there. Nimesh Chandan is with us from Bajaj Finserv Asset Management. Nimesh, good to have you with us here. I think we've had you in the studio the last couple of times, and good to chat like this as well. Just a quick word, Nimesh, on the move that we are seeing on. I know that you've had a positive view on capex and sort of infra and those kind of plays, and you think the runway for growth is long, but some of the moves here are really something astounding. Can one justify a 300% move in a stock? Whatever the news flow, whatever the positives. I'm talking about Cochin Shipyard. Just to take one example, for example. And it's not, by the way, 300%, it's 310% now with today's gains. What's the sense, Nimesh, on two areas actually in the infra space? One is defense and the other is power. Yeah.
Always good to be on your show, Prashant. And you're right. In our indicators now, we are seeing that the overall market has moved a little above fair value. This is the large cap companies. Mid caps and small caps are about 25% to 30% now above their fair values that we calculate here at Bajaj Finserv AMC. So very little value left in the market. Most of the news or positives are discounted. While capex continues to be a good long-term story, there are some pockets like power, for example, is still a mega trend that we believe in. But valuations have now captured a large part of what we will see unfolding over the next few years, maybe next at least 3 to 5 years. So valuations are getting discounted, positives are getting discounted. In some sectors, like you mentioned, defense, because the number of plays that people have are very few, typically you see a very exaggerated move in those companies, and that's what has happened, that the valuations of those companies have moved significantly higher because people had very few stocks to invest in to play that particular theme. So we are looking at some contrarian picks, and even after the election results, we think now is the time for looking at the consumer space, looking at some of the contrarian bets, like, for example, chemicals. So we are positioning ourselves to be a little more contrarian and expecting some correction coming in the market anytime.
All right. Hi, Nimesh. Good afternoon and good to see you. Nigel on this side. I recall that call you made on chemicals, actually. And now a lot of the street is coming to terms with that maybe the second half of the year is going to be far better, both on pricing and demand. And also some of these companies have been looking at that backward integration. The benefits will start flowing through as well. What do you like from this space? And do you believe now we are towards the end of that, those EPS downgrades and things will look up?
Hi, Nigel. So you are absolutely right. We have been accumulating, or we have been positive on chemical stocks for some time in our portfolios. This market, it has a lot of investors who have very little patience. So people are not very happy when they hear that 1 quarter or 2 quarter of a long-term good business will be a little moderate or mediocre. So they are avoiding some of these companies and stocks. And for investment managers like us who have a long-term investment philosophy, these become very good picks. Chemical sector has some fantastic companies. They've got encouragement from the government in terms of PLIs to expand capacities. Globally also, they are increasing their market share. So we've seen till now some revival in volumes in some of the specialty chemicals and especially dyes and pigment chemical area. A little slow on the agri-chemical side. Second half is very critical to see whether this volume growth will turn into price growth, and then the next leg of re-rating may happen for these companies.
Right, Nimesh, got that. So that's on the chemicals front. Want to get your take on financial services, because we're in the midst of getting all of these quarterly updates, and it's quite interesting actually looking at the data and the market's reaction. I mean, I'm just giving examples. I know you can't get into individual stocks, but for instance, Bajaj Finance came out with what looked like a robust number at 30%. The market kind of took it in its stride. Today, HDFC Bank's slightly, less impressive number is seeing a very sharp reaction. Most of the banking names that at least I've seen, I mean, deposit growth is actually fairly lackluster or negative. So just on financials, because, everyone's waiting for this big move to take place on large banks, I mean, what should we be prepared for as we start looking at the quarterly numbers?
See, I would stick my neck out and say that in the BFSI space, you can find good value picks at these levels, because many say on the banking side, you are seeing many banks which can sustain their ROEs above 16% are available at a 1.5 year or 1 year forward basis of 1.8 to 2.2 times price to book. So that's an attractive valuation according to me. Cost of funds is likely to start moving down as interest rates start coming down. This will help the NBFCs also. Of course, the growth in NBFCs will depend on which segment they are present in or dominant in. So selectively, NBFCs can actually see a good growth from here and with good valuations. So it's a good time to pick in this sector. We are also bullish on the insurance side, where we believe that life insurance is now attractively placed. Even the growth in general insurance is better. For the overall credit in the market, we've seen credit growth in the banking sector coming down to about 13%. So we expect it to be around 12 to 14% for the rest of the year. Even the deposit growth would be around the same level. So that stark difference between credit growth and deposit growth may actually narrow down substantially. So this is the area where one can look for good long-term picks. And yes, some of these companies may have their own specific issues, but I don't believe that that the entire sector can be painted in one brush. But there are a lot of value picks here.
Nimesh, hi. You said you're expecting some correction in the market. What is it that you anticipate? What could perhaps, be the straw that breaks the camel's back? Because valuations have been high and still money is flowing in. Is it going to be some earnings disappointment, something on the global front? What's the, the macro construct, which could precipitate a fall?
When one tries to be a contrarian in this raging bull market, one may look stupid for some time or foolish for some time. And that's the risk we carry. Being early sometimes looks like being wrong. We value the markets on fundamentals and behavioral models. These are proprietary models we look at. You won't believe last year when we launched our funds and the market was at 20 to 21,000 range, a lot of investors told us it's an expensive market, you won't make money here. Now at 24,000, when we say we expect a correction and the markets are slightly over fair value, people again don't believe us. People feel that, okay, markets can continue to rally from here. We've seen good rally. Possibly the negative news can come from certain international pockets, maybe a sharp slowdown in the US, continued slowdown in China. There could be some disappointment at the pace at which people expect the inflation and the interest rates to come down. So those can be the triggers. Typically, when there is some slowdown in economy, global economy, you will find some earnings downgrade coming in. And in a market which is priced to perfection and expecting high earnings growth, even a small disappointment can cause a correction. I'm not bearish on the market to say we are in a bear market, but this will be a correction or an interim top in a good long-term bull market in the country.
Okay. When you say this, Nimesh, this is what, 2% away, 3% away, 5% away, or we were already there? What's the?
So it's the technical definitions of correction start from 2% to 20%, Prashant. So
No. I'm saying forget about the correction. That can be. I'm saying you said interim top. So you're saying I said this could be an interim. I'm saying is it already we already there, or you think it's some distance away even from here?
Difficult to say exact top, but Prashant, the signs are that we are around this level where we wait for some time.
increased your cash holding, or where is it that you've booked profits?
So we have certain funds where we work according to our view on the market. So our Balance Advantage Fund takes a combination of fundamental and behavioral indicators and allocates money based on that. So we have reduced our net equity allocation in that fund right now. We also have a multi-asset fund where we are on the lower side of what our equity holdings would be. In some of the other funds where, say, a flexi cap or in the large and mid cap fund that we have, we don't take cash calls, but we would want to be in areas where we see less froth in terms of valuation, and we find attractive models of businesses which are going through some short-term pain. So some contrarian bets we pick up.
All right, got that, Nimesh. It's been a pleasure speaking with you. Thank you so much for joining. And I think a word of caution is really warranted at times. It's good to take that on board as well in a market like this. You have a good weekend. Look forward to connecting again. Well, we do have to take a break, but as we do that, it's a very, very special day. It's a day to remember legendary Indian investor Rakesh Jhunjhunwala. It is his 64th birthday today, and the street will always remember